What's up, folks? Trail here, and I want to know how many of you out there have a mortgage that increases every single year and you don't even know why. I'm sure most of you did raise your hands, considering this is normal after purchasing a home. Mortgage lenders tell you that your total price for the mortgage will be a certain amount, but they never reveal the actual breakdown, which includes the principal, the interest, and the escrow account. Now, you might ask, what is an escrow? Well, shockingly, most first-time home buyers have no clue what this is. But because this channel is all about finance and building your wealth, I'm going to be explaining to you what an escrow account is and how it can benefit you and why I believe that you should not escrow your mortgage. But before we get started, please take the time to subscribe to the channel as well as hit the like button, as it really helps us grow on YouTube. Okay, let's go ahead and start off by explaining to you what an escrow account is. An escrow account is an account that is included when you purchase a home that works along with your mortgage payment. An escrow is a legal arrangement between you and a third party that will temporarily hold your money until a condition is met according to the agreement. It is used in real estate transactions to protect both the buyer and the seller throughout the buying process or throughout the term of the mortgage. And typically the escrow is used to hold the funds for taxes and homeowners insurance on the property. I hope all of that made sense to you. But now that we have gotten that out the way, I have a question for you. Do you escrow your home for your taxes and your insurance? And if you do, that's totally fine. But in this video, I'm going to explain to you why you should not escrow your home. Now, take a trip down memory lane with me for a second. Now, it was 2005 when I purchased my first home, and I knew absolutely nothing. I didn't know much about buying a home, paying for taxes, paying for property taxes, or anything like that. The one thing that I did know was that I needed to save up a lot of money and make sure that my credit score was around an A+. So I personally lived at home with my parents until I was 27 years old, and I saved up a substantial amount of money and built my credit score to around 750 points. By doing that, I knew that I would have the best chance to buy my first home without any hiccups. Now, because I knew nothing about the process, I ended up reaching out to one of my good friends that was fairly wealthy, and he was smart and savvy and good with his money, if you will. I asked him to be my mentor during this process, and he taught me not to escrow my home purchase. The thing I like about his teaching the most is that he gave me all of the options and the benefits so that I could make up my own decision based on the facts that was in front of me. So if you are new to mortgages or plan on buying a home very soon, this is what I am talking about right here. Your monthly mortgage payment typically includes the principal plus amortized interest of the loan. The mortgage company even tries to adjust it for any small increases by allowing a few extra dollars to be added into the escrow per month just in case, which overall should be more than enough to cover the annual expenses. Now, lenders highly prefer the option of escrow for two specific reasons. Number one, to guarantee your property taxes is paid to the city so that they don't have to put a lien on your home. And then number two, probably to make more money on your escrow account without you even knowing. Now, I get it. I'm personally not a lender or a mortgage company, so I don't have hard evidence of what they really do with your money in your escrow account. But I have a hard time believing that money is sitting in a bank account for millions of Americans earning zero interest. Banks are smart, guys. They are very smart. So I seriously doubt that. But my speculation is that they are definitely earning interest while lending out your percentage of the total escrow accounts to someone else. Reality is that this is how banks make millions of dollars every single year, by investing other people's deposits into their bank. So yeah, that's my theory, guys. But I had to ask myself the question, couldn't I do the same thing that banks do with my escrow account? Couldn't I invest that money to earn interest of it? Yes, guys. I can. I mean, I consider myself responsible with paying all of my bills as normal, but when you buy a home, they want you to give the money to them to hold it for you for the entire year, and then pay your insurance and property taxes in December when they are actually due. So if you do decide to go this route, guys, it's important to make sure you're actually saving that money, including a little bit of an extra cushion to pay the bill when it's actually due, because if you don't, they could issue a lien against your home and you could end up losing it altogether. But just like all the other bills, guys, we have to pay on a monthly basis. Consequences can actually happen when we don't pay our liabilities. So overall, that is the first reason as to why I suggest you do not escrow your mortgage. Just save the money yourself, put that money into a high yield savings account that earns you around 5% per month, and then by the end of the year or in December, make that full payment to the city and your insurance company. This can generate you some additional money in the process. In the finance world, guys, we call this passive income. So anyways, guys, now to the second reason I suggest that you do not escrow your account is because of the opportunity to get free vacations. Let me explain. My last house that I owned was in an area with a high property tax rate, which taxes could be anywhere between $10,000 and $25,000 per year. But for context, we are going to keep it very simple in this video as an example and use $15,000 as our annual property tax amount. And then the insurance would typically run about $3,000 per year. That's a total of $18,000 when you add both together. So because you want to be more savvy in the future and you no longer want to escrow your property, you need to save $18,000 by the end of the year to make that payment, which is around $1,500 per month, which needs to be put into a high yield savings account that earns you 5% as of making of this video. Now, this is going to benefit you in two ways. The first one is that $1,500 per month making 5% interest is going to be earning around $75 per month. That's free money you can earn per month for the entire year, assuming interest is still above 5%. And then the second reason is that you can use a credit card to make that payment and earn reward points for free travel. And then after using your credit card, pay it off as soon as possible using the money that you've saved in your high yield savings account. That $18,000 charge would yield you around 18,000 points, which is equivalent to $180. So yeah, you can make money by using a credit card to pay your bills, which we have talked about this previously in other videos, but I have an additional sweet spot that can be even bigger rewards for you. Y'all know I love to get new credit cards, right? With huge welcome bonuses. So let me walk you through this process of what I like to do. Around the November time frame, a month before taxes and insurance is actually due, I start looking for new credit cards with hefty reward bonuses. For example, you can typically get a new credit card and receive around 100,000 reward points after spending like $5,000. Keep in mind, you need to spend $18,000 by the end of December, which means you can literally get around 3 credit cards with a minimum spend of $5,000 each for this option to maximize the best value. But let's keep it simple and only apply for like 2 credit cards instead. So we have 2 new credit cards with a minimum spend of $5,000 each. We are going to use both cards to pay $5,000 towards the total $18,000 bill that's due. Then we have $8,000 remaining. I hope you are following along with me. So for both cards, you met the minimum spend in order to receive the welcome bonus of 100,000 points from each credit card for a total of 200,000 points. This is huge because you can literally cash those points in and receive $2,000 total. Or if you're like me, you can save those points and use them to pay for your next family vacation. Me personally, I have a family of 4 people, and with 200,000 points, I can pay for flights to Cancun or Jamaica, plus have an all-inclusive hotel for at least 5 nights for me and my family, and still have points remaining. This type of trip would cost more than $2,000 if you paid for it in cash. So yeah, this is exactly how I maximize the option of not escrowing my mortgage. For those that don't know, I actually own 5 single-family homes and I don't escrow on any of them, which means means my annual bill is typically more than $35,000 per year, which helps me receive thousands of reward points every single year by using this particular method. Now, I know this was a lot to process in this video, so I would encourage you to watch the video again and try to follow along using the examples that we've already talked about. And then obviously, if you have more questions, don't hesitate to ask them down below in the comment section. By avoiding an escrow account with your lender and preventing them from reaping the interest and reward benefits from holding your $18,000 until the end of the year opens up opportunities for you and your family. If you do this correctly, it will give you more control of the situation while making some easy money in the process. Passive income. Now, full disclaimer, guys, if you are not responsible with your money and don't trust yourself to be the gatekeeper of such a large amount of money until the end of the year, or if you're that type of person that gets the burning sensation in your pocket whenever you come across some extra money, then by all means continue to use the escrow account method and have someone else hold on to your money. But for those of you who are good at managing your money, good at saving, good at using your money as a vehicle to make more money, then this might actually be for you. So if you're thinking about buying a new home or refinancing your current home, this is the best time to determine whether or not you will avoid escrowing your mortgage to make your money work for you. If you decide to make that leap, I have another video for you to check out regarding high yield savings accounts that are paying more than 5% on your money. Use that to store your monthly escrow account until the end of the year, and you will start to see how your money can work for you and potentially make more money. If you have any questions or concerns outside of those, don't hesitate to ask them. But anyways, if it's your first time to the channel, consider subscribing as we discuss ways to build wealth through finance, credit cards, and real estate on this channel. And if you found value in this video, go ahead and hit the like button for us, as it helps us grow on YouTube. Other than that, hey, I appreciate you guys watching this, and I will see you on the next one.